Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hi everyone, this is Shaily Gang, Chief Investment Strategist at Standard Chartered Bank India. On this podcast, I plan to lay out the current macro setup and discuss about what is driving the markets. First up, an update on US-Iran conflict. Hope is a good thing and no good thing ever dies. Equity markets are now pinning their hopes on the meeting between US President Donald Trump and Chinese leader Xi Jinping to break the stalemate on US-Iran conflict. If China is able to ease Middle East tensions while mediating and influencing, Iran being its key trade partner, there could be a relief rally across equity markets, including India. Other discussions expected in this key meeting are trade tariffs, AI-related agendas, Taiwan. Archimedes said, "Give me a lever long enough and a fulcrum on which to place it, and I shall move the world." With the right tool and right conditions, massive problems can be solved. Laying it in the current context of things, a great design of negotiated settlement is required to reach a resolution in the US-Iran conflict. However, beyond the truce itself, normalization of physical oil flows and shipping data will be the next key milestones to watch. At this juncture, it is critical to discuss oil and rupee. Brent crude oil is trading at $106 per barrel as the US-Iran conflict continues to be fragile. India's current account deficit is expected to rise, driven largely by gold imports and crude oil imports. Risk of balance of payments deficit widening due to higher oil prices and sustained portfolio outflows have been weighing on rupee. Rupee plunged to a new low on Thursday and continues to trade above rupees 95 per dollar. RBI has deployed various measures and policy tools to support the rupee. RBI has net sold close to $12 billion in the spot market across March and April 2026. Though India's forex reserves stand robust as we speak, conventional spot market intervention by RBI is depleting reserves. Thus, RBI has intervened via its forward book as well. When RBI agrees to buy or sell dollars at a future date in the forward market, it does not immediately affect reserves but creates a future obligation. When forward sales are more than forward purchases, the forward book becomes net short. When those forward sale contracts mature, RBI must deliver USD, which means it draws down spot reserves at that future date. RBI's net short forward book has grown to an estimated $100+ billion by March-April 2026, creating future vulnerability. Last month, RBI had capped net open position limit to $100 million per bank to force banks to reduce long USD positions. Banks and corporates were exploiting the spread between onshore and offshore NDF markets, which is non-deliverable forward markets, through arbitrage, amplifying rupee weakness. The regulator has taken measures to arrest the same. RBI would be deploying further measures and policy tools. The government is considering a significant reduction in the withholding tax paid by foreign investors on bond coupons as proposed by RBI to attract flows. Meanwhile, markets and investors are tracking Trump's Xi meeting and hoping for positive developments. Oil is a fulcrum for manufacturing, growth, current account deficit, rupee, inflation, rates. If it stays elevated, can impact most things. If it behaves well, can provide a lot of solace to markets and economy. Crude oil price rises get absorbed in India by the oil marketing companies. Subsidies are provided by the government. And with today's price hike of petrol and diesel, with immediate effect, some bit is being passed on to the consumers as well. Next up on India equity markets, what is guiding them? India equity markets are being guided by the dual forces of tough external situation with respect to oil prices and rupee weakening and balance of payment deficit, and stable earnings plus domestic fundamentals, one overpowering the other week to week. Over the last 4 to 5 sessions, external forces are driving the India equity market narrative with some value buying in between. India volatility index rose and was trading closer to 20. If the Trump-Xi meeting sees in success, India equity markets would move focus to domestic fundamentals and earnings from external pressures, which have been overpowering last few trading sessions. Moving ahead, what is powering global equity markets? Vidya Sarvajayini, Vidya Vignaharini. Knowledge wins over everything, knowledge removes all obstacles. Earnings have played a similar role. Earnings have aided global equity markets to tide over all economic uncertainty caused by the unresolved US-Iran conflict. Global equity markets have largely brushed aside concerns over the Iran war, its inflationary impact, and higher than expected recent US inflation data. Global equity markets have held well with continued strength in technology and chip-making stocks, memory upcycle, chip profits, all powered by AI-driven earnings and AI capex, though the recent equity rally has been highly concentrated. Importantly, on India bond markets now. Lingering geopolitical tensions, higher inflationary pressures amid elevated crude oil prices are likely to keep long 10-year bond yields in India above 7% and possibly lead to a pivot in the RBI's policy in second half of FY27. Short maturity government security bond space look attractive, aided by ample systemic liquidity and balanced demand-supply dynamics. We also like high-quality short-term corporate bonds, given their attractive absolute yields and high spreads over government bonds. That brings us to global fixed income markets. Global bond yields have risen to multi-year highs due to geopolitical tensions and persistent inflation concerns. The question is whether central banks are pivoting yet due to rising inflation risks. US Fed is facing a significant challenge navigating a difficult mix of persistent inflation and unemployment, forces that argue in opposite directions. US Fed to hold rates in H1 and cut rates by 25 bips by December 26. This is our expectation. We expect ECB and BOE to hold rates in H1 and remain vigilant about the new data forecasts. ECB pivoted away from its initially hawkish tone and is expected to do one hike in 2026. By December 26, Japan is expected to hike rates by 50 bips to deal with unanchoring inflation expected above 2%, while China PBOC could pivot to some bit of tightening. Talking about global macro, how has oil shaped the trinity of dollar rates and gold recently? Inflation is the start point of this find your way puzzle. The outlook for inflation has been mainly tied to the crude oil and whether the persistent price pressure will drive policy tightening from major central banks. As long as the situation in Strait of Hormuz is unresolved, it is difficult to see crude giving up much ground, and thus the risk of high inflation would continue to persist. High oil prices has given way to a stronger dollar, rising long-end yields, while short-end yields remain supported. Elevated oil prices tend to keep short-end US yields supported with them the US dollar. If crude continues to grind higher, the dollar looks set to hold firm against the currencies of energy importing regions. Gold, globally, it has become dual-natured. A stronger dollar and rising yields both press against the gold's appeal. Gold faces downside pressure from elevated oil prices, hawkish commentary from central banks, rising yields, and a strong US dollar. Safe haven demand amid ongoing geopolitical tensions in the Middle East continues to limit deeper downside risks. Although this has played a lesser role recently because investors now treat gold more as a risk asset than a safe haven. Still, the need to hedge fiat currencies against inflation, coupled with the ongoing central bank buying, means that the downside to gold has been limited so far. Let's talk about INR gold. India's current account deficit is expected to rise, driven largely by gold imports and crude oil imports. RBI recently increased import duty on gold and silver imports to provide relief to rupee. Additionally, on Thursday, government announced stricter conditions for gold imports above 100 kgs. With rising energy prices, lower gold imports would ease pressure on the rupee. India has over 800 tons of gold holdings, which is close to 17% of gold's share in India's forex reserves, which is a decent share. India's annual demand for gold is approximately 700 metric tons. On a separate note, India has brought back a good chunk of gold reserves into India which were held overseas. So these are challenging times, but let us not miss the moon while counting the stars. These are times to build portfolios basis attractive segments and pockets across asset classes. See you all soon in the next episode. Until then, take care and happy investing. Thank you.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.